We'll start now itself. Good afternoon, everybody. Welcome to this webinar. Thank you for joining. Most of you know me already. As for Ibrahim, working with financial advisor with Continental Financial Service. Uh, we have been associated with NJ Group back in India for more than 10 years. NJ Group is one of the largest distributor in the mutual funds in back home, with an AUM size of 85,000 crores. For today's webinar, we have Mr. Anand Varadarajan, who is Head of Global Investment at NJ Group, who has rich experience in India as well as the international markets. I'm delighted he has joined us today, and he has been awarded also for winner of prestigious 40 under 40 award in India recently. As mentioned earlier, today's webinar topics will be what is the current market looks like during this COVID, and what is the uh, future outlook for the Indian market, and why India is on top of the all the emerging market to invest in, and what you need to do as an investor. We'll also try to wrap up this webinar in 30 to 40 minutes. Uh, if you have any questions, you can see a icon below with Q&A. You can post your questions there. Also, during the presentation, also you can do post the questions. Accordingly, we'll answer after the presentation is done. And thank you once again for joining for this webinar. Thanks, Anand, for joining for this thing. And over to you, Anand.
Yeah, thank you very much, Asfar, and thank you for having me over. It's always a pleasure to come online and chat up with you and address your clients. A lot of your clients are ones whom I've already met. So hello to everyone once again. This time from India and not in the UAE. So a lot of you all I've met you personally in the UAE, but this time I'm talking to you from India, considering the COVID-19 situation. So I hope all of you all are doing well, and I hope your families and everyone is still safe as we speak right now. And so like Asfar mentioned, my briefing or my session is going to last about 30 to 25 to 30 minutes from a briefing standpoint. And after that, we will take the question and answer session. In the meanwhile, during my session, if you have some questions that are coming across, please feel free to log it in the chat section or the Q&A section. I'll be more than happy to take them up at the end of the session. All right. And also, Asfar will be running a couple of polls during the presentation for us to get a sense of understanding of what you all think about a couple of aspects. So we will run a couple of polls in the beginning, during, and also at the end of the session. So please make sure all of you all participate in the poll. All right. So to get into the session today, the first point that we want to talk about is the weird dichotomy. Okay, I believe that as investors, okay, most of us live in a state of weird dichotomy. So what do I believe is the weird dichotomy is what we would like to talk about right now. The first thing that investors think is that they should research and look at and research a lot, and they should decide and they should think about which stock to buy or which fund to buy, so on and so forth. But the reality is, what you see on the bottom of my screen is stocks or fund picking is not important, but staying invested for a long term is very, very important. So that's the first dichotomy that I would like to bust. Second is the markets are attractive. So these 2 points, what you see here on my screen, these two come in parallel or come in, I mean, they are a similar kind of dichotomy that happen at different times of the market. So what it means is, when the markets, when the emotions, when the news, and when the rumors of the market are on an upbeat, that is a time when all of us are motivated to invest. That is a time when all of us bring in all our money and then put it in the market. And when the markets are going down, the news is negative, the markets are negative, everything around us are negative. So that is the time when we probably end up redeeming the money. But the reality is it should be the other way around. So when the markets are moving up, that is practically a time when you really need to book profits from your equity and move into debt. And when the markets are falling down, that's actually a time when you need to really get out of debt and buy equity at an undervaluation. So these are two things that exist as a weird state of dichotomy as we speak right now. The third thing is, let me build a proper lifestyle. I'm earning enough money to take care of the future. So most investors today live in a state of mind where they say that I need to take care of my current lifestyle. Okay, I need to make sure that I have a good car, I have a good house, I have a good lifestyle, and my future and the earnings and savings is something that will get taken care of in the future. So let me not worry about it right now. So that is not the right situation or right mindset to be in. What is important is that you need to focus on starting early, start your career early, create your goals, define your goals, and work towards it. Next is what I call as a mythical formula versus the magical formula, where a lot of people, what they believe in is, if I'm earning X amount of rupees minus whatever is my expenses, whatever money is left, that's all I will be able to invest. That is all I will invest. That is a very wrong way of looking at it. Please get this right. The right way of looking at it is, you need to be able to understand and arrive at what are your financial goals and how much money do you need to contribute on a monthly basis to arrive at those financial goals. So basically, the actual formula that you need to follow is income minus investments is equal to the expenses. So you should spend only the money that is left over after you've planned your investment. So in essence, when you build your list of expenses in your salary or in your total income, the first line item should be your investments, right? That is what you should be really mindful of, and that is what you should bear in mind always. Next thing is, we believe that you can look up on Google, check with friends, family, WhatsApp, university, all of that, and you can build a good investment model and an investment plan for you. Please get this right. That's not going to happen. That is not going to help. You need to get the right advisor on your side to make sure that you have your investments and the plans clearly laid out. Okay, so Aswar, I think you should bring up the first poll. Is a question where a lot of us think that equity is risky. So now let us ask you this question. Can you bring up the first poll, Aswar?
Yes.
So the question here is, how many of you all think that investing in equity as an asset class is risky? So we will probably leave you with this for about 15 to 20 seconds, and you could poll in, please. I mean, a lot of us see that when the markets are falling, the wealth is falling down by 20%, 30%. And everybody, a lot of people in the last 6 months have been telling me, Anand, this is the time I want to retire, and 30% of my wealth is lost. So at a time when I want to retire, I don't have enough money. So that is why we think equity is risky. That is why we believe that FD is good. So I want to get a sense of what you people are thinking.
Okay.
Right. So I think Aswar, have most of them voted.
Yes, 65% of them have voted.
Okay, so can you share the poll results, please?
Yes. So the results is 87%.
Wow, that's an interesting number. Okay, so practically 87% of the people on this webinar who have voted today believe that equity is risky and equity is not good for them. Okay, 87% of them believe that equity is risky and that's not the right asset class to be. Okay, so now let's look at what is the reality. All right, so I'm going to go again into my presentation. So let's look at the Sensex journey. Okay, if you look at the Sensex journey, okay, if we look at a period of 1993 to where we are today, we have seen the markets have gone up, gone down, gone up, gone down. There are various events that have happened on the market, so on and so forth. Lehman Brothers crisis, Satyam episode, Fed rate hikes, okay, Eurozone debt crisis. We've seen all of this. But when we've seen that during different periods in time, markets have gone up and come down, ultimately where the market started and where we are today, ultimately the markets have created wealth for you. Okay, so I think that's something which is very important to understand, that in short term you can see volatilities that are as steep as this, what you see here on my screen where my mouse is pointing to. You can see volatilities which are as steep as this. You can see falls in the market which are as steep as this, but over a period of time you will very clearly see that the markets have performed over a long term, and you are able to generate return over a long term. So Asfar, you'll have to keep in mind if people are waiting to be admitted. Huh?
Yeah, wait. Yeah. So
Right. So moving to the next slide, we believe that market volatility is a good investment opportunity. So a lot of y'all will think that, oh, okay, market is falling by 20%, 30%, it is risky, so it's not a good time to invest. So let's look at four of the very important occurrences that have happened in the market in the past. Okay, so the first thing is when WTC attack happened in the US, okay, the market took a 54.8% beating. So from the peak, the market fell by 54.8%, and exact and investors who stayed invested for a year after could generate a return of about 15.8%. Investors who stayed invested for 2 years after that got 25.7%. 3 years later, 27.5%. 5 years after that, 35.1%. So even after a 54% fall in the market, over 1 year, 2 year, 3 year, 5 year, the markets have delivered significant returns. And then if you look at the other major issue which happened in 2009, which was the US subprime crisis, okay, where the Indian markets, Nifty was at about 20,800 levels, it fell by about almost 61%. And it came down to 8,160 levels, okay, where if you take a look at it, 1 year, the market fell by 108%. 2 years, the market fell by 50.4%. 3 years, the market, sorry, not fell by, 61% was what the market fell by. But exactly 1 year after that, the market delivered a positive return of 108%. 2 years after that, the market delivered 50%. 3 years, 5 years, the market delivered anywhere between the 20% and above sort of return. So what we're trying to say is, even after we've seen a 60% fall in the market due to a particular event, we have seen that 1 year, 3 year, 5 years after that, the market has delivered a significant returns. So a lot of y'all must be thinking that these are due to global crisis, but these are more technical in nature. And what we are living today in the state of COVID-19 is a pandemic, and that is very different from everything else. So now let me talk about what have been the various pandemics in the past. So like what I keep telling my clients and everybody whom I speak to is, we have and we will tide over the various pandemics also. Okay, so why do I say this? Where does my confidence on this come from? Okay, so first let's look at when SARS happened. When SARS happened, the Indian benchmark delivered a negative return of 10.7%. Immediately 1 year after, the Indian benchmarks delivered 83.38% in exactly 1 year after that. Okay, so next, when you look at what happened during when the avian influenza happened. When avian influenza happened, the market fell by 12.23% during that period, and exactly 1 year after, the market delivered 50.33%. When Ebola happened, the market fell by 1.58%, whereas 1 year after, the market delivered 39.02%. When Zika virus happened, the market in India fell by 13.14%, whereas 1 year after, the market delivered 24.14%. Similarly, when the COVID-19 situation is happening, right now, as of end of February, the market delivered 7.17% negative return. But as we speak right now, the market is down by about 25 to 27%. So when we've seen that markets in the past have recovered, I don't see a reason why even after COVID-19 or even after coronavirus, why the market should not recover. I don't see a reason. A lot of y'all will be thinking that coronavirus is very different from Ebola or Zika or SARS. But let me tell you, I've been speaking to a lot of doctors, okay? And a lot of doctors also tell me that COVID-19 is not different from SARS or Ebola in terms of its nature when it actually started. Okay, but the thing is that the fear of the virus and the fear of the unknown is what is driving the major crisis. Okay, second thing, what was majorly different from SARS to COVID-19? If you see what has been significantly different, the only thing which is significantly been different from SARS to COVID-19 is the emergence of social media. The WhatsApp university, the Facebook world, the Twitter world, the Googles, the YouTubes, and all the people who are coming to the fore with half knowledge. These are the people who are complicating the environment. So that is why we see that today the state of panic is much higher than what it would have been or what it could have been when SARS or avian or Ebola or Zika actually happened, right? So now let's go into the next part of the presentation to understand what actually drives the equity market. Okay, what actually drives the equity market? In short term, We can have sentiments, we can have liquidity, we can have news flow, we can have emotions, we can have rumors, we can have trading volumes, we can have demand supply gaps. A lot of these things can play a role in terms of moving the market upward or downward. But what is important to understand is over long term, earnings growth rate and equity prices are what is going to drive the market upwards or downwards. So that is something which we need to stay focused on. The next thing is, Asfar, I would want you to bring up the second question about mutual funds, please.
Yeah. Continue.
So the question is, how many of you all today have invested in mutual funds? Have you all invested in mutual funds? Yes or no? Can we have your answer in, please? Okay, so I would like to give you a hint when you answer this question. If you have, let's say, less than 5% of your total investment surplus allocated to mutual funds, you should say no, don't say yes. If your investment surplus is 1 crore rupees and if you've allocated only less than 5% of that to mutual funds, your answer should be no, not yes.
Okay, I'm ending the poll.
Right? So can you share the results of that?
Yes.
You see, 68% of people say that they've invested in mutual funds and 32% have not invested in mutual funds, right? So I think what's important to understand is out of the 68% also, what's important to understand is how many of them have really taken full exposure to mutual funds. That would be a very interesting number to see. So, but we still see that about 32% after having known Asfar for a long time have still not invested in mutual funds. So that's a very important number to focus on. So now let's try and understand why mutual funds. Okay. So what is very important to understand is that everyone's life is similar to a walking stick. Why do I say that your life is similar to a walking stick? Can you take a look at this picture for a minute? I will leave you for about 10 seconds. Okay, so if you think about it, what is important to understand is that everybody's life, every individual's life will fall under the graph of a walking stick. It will be similar to the shape of a walking stick. Why do I say that? Okay, so first, the 22 to 40 years period of a human's lifestyle, of a human's life, is a phase where he's earning a lot of money. Okay, the age of 40 to 50 is a time when he's actually needing to grow the money, because at the age of 22 to 40 he's earning a lot of money, he has age on his side, his capability to take risk is much higher. But when he goes to the age of 40 to 50, he's moving closer to his retirement, his capability to take risk is coming down, and he would want to be focused on how can he build his retirement life in a very sustainable way. So that is what he's talking about he's thinking about when he's in the age of 40 to 50. The last piece, if you look at it, is the reaping phase, when one reaches the age of 50 plus. So when you're in the phase of 22 to 40, or you're at the age of 40 to 50, or when you're at the age of 50 plus, you need to be able to decide how much money should be in equity and how much money to be in debt. Obviously, that is something you cannot decide. That is something we as advisors will decide for you. So here in this phase, you are taking risk and really putting your money to risk and earning a lot of returns. Here you have to move away from equity and focus on large cap and blue chip oriented portfolios to make sure that your money is safe and not taking too much risk. And when it comes to the 50 plus age, that is when you need to move towards a balanced fund or that kind of an approach where you start getting money back and it starts paying you. Your money has to work for you. So that is what is more important. That is why we believe that mutual funds are good. Why do I say mutual funds are good? Now, if you take a look at it, why mutual funds are good for you? Because you don't really need to pick stocks on your own basis and need to do research on your own. Mutual funds are a pole oriented methodology of investing, hence the risk is diversified. and hence the reward is also diversified. Third, investing in mutual funds is a broad-based approach where the mutual fund manager is picking up anywhere between 50 to 100 stocks for you to buy a portfolio of stocks for you in the mutual fund. Fourth point is that it is managed by a professional and it's managed by experienced guys. So that is why it's important for you and it's good for you. Last point is it comes with complete liquidity. Whenever you want the money on a 3 to 5 days basis, you have the money with you and it still gives you a good wealth creation opportunity. So these are the reasons why we believe that mutual funds are good for you. Next point is to look at, I'm not focusing on the return specifically, but I want you all to focus on the bottom part of the chart, where if you look at equity mutual funds versus Sensex, the probability of equity mutual funds delivering a loss to you over a 5-year period when compared to Sensex is almost zero. So the mutual funds over a 5-year period, the possibility of causing loss is zero, whereas the benchmark or Nifty would still have a 9% sort of probability of delivering negative returns. As against that, the mutual funds are still delivering a 4% to 4.2% outperformance over the benchmark. So your probability of losing money is almost zero, and you are still able to get a 4% outperformance over the benchmark. So that's the significant advantage that mutual funds are bringing to you. But having said that, there are 4 important points to remember. First thing, do not panic during short-term correction. Corrections are the flavor of the market. Corrections are in the nature of the market. So when markets are correcting, do not panic. Stay focused. Next thing, time in the market is more important than timing the market. It is not possible to time the market. Be very, very clear about this. Okay. So be focused on staying and spending time in the market rather than timing the market. So that's the second important point. Third, every correction is an investment opportunity. So every time the market falls, the NAV is falling. So you're probably getting more units for the buck that you're really investing. Fourth point is power of compounding is magical. If you look at the power of compounding, okay, that is absolutely magical in nature. The rate at which your money keeps compounding, that is absolutely a crazy phenomena. That is what I call as the 8th wonder of the world. Yeah. Next thing. So, Asfar, can you bring up the next survey, please? So, can you brief them about this question, please, Asfar?
Uh, everybody it's like a systematic investment plan where you have invested with the mutual funds on a monthly basis. Have you done anything of this sort of investments in your investment period?
So what SIP typically means is that you arrive at what is your financial goal and you decide that this is the amount of money that I want to allocate on a month-on-month basis to the mutual funds, and you allocate a monthly budget to SIP. So how many of you all are today actually doing it? Again, before you all give your answer, if your allocation to SIP is less than 10% of your monthly salary, you should respond no. Yeah, Swar, can you bring up the results, please?
Yes.
Wow. So only 60%. So 40% of the people who are on this webinar today are not allocating money to mutual funds using an SIP as a route. Okay. This is very, very scary. Okay. This is extremely scary. Now, for the 40% who have said no, and for the 60% who have said yes, and are still contributing less than 10% of your monthly salary to SIP, this is what I have to share to you. First, what are the benefits of SIP? First thing is that SIP imparts financial discipline to your life. So the thing that I told you, total income minus expenses is equal to investments, which is your current model. That will get changed if you start doing SIPs. Second, SIP is important because you are investing irrespective of market conditions. So whether market is going up or the market is going down, you're investing every month. So that is why SIP is very, very important. Third, because you're investing every month. So there is a rupee cost averaging that happens. So you're buying at peaks, you're buying at falls. So there's a rupee cost averaging that happens. So that is why it neutralizes the market volatility effect on your portfolio. Last but not the least, you get the power of compounding. Okay. I'm sure a lot of y'all in this room are already a crorepati. I'm sure. But if you're not, and if you have friends, family, relatives, and your children also, okay, you can make them a crorepati by starting an SIP or doing an SIP. Why do I say this? So let me give you a simple example. Asfar,
Yes.
let me ask you,
Yes.
if you go out with your family for
Hmm.
a dinner over a weekend, how much do you spend?
At this point of time, there is only savings.
I know. Right now you're only saving, but otherwise, I'm talking
But
about
otherwise, on
pre-COVID.
an average, we spend 400 dirhams average on a weekend, or 400 to
Yeah.
500
So
dirhams.
considering that you have two small children, okay, and you and your wife, okay, so you're spending on an average of anywhere between 400 to 500 dirhams every weekend for a dinner if you're going out,
Yeah.
right? So what I am asking all the people on this video call today, on this webinar today, is that if you can save 500 dirhams a month, as small as that, which is like, let's say 10,000 rupees, and if you manage to do it every year for a period of 10 years, the total amount that you're going to accumulate by contributing 10,000 rupees every month or 500 dirhams every month is a value of 12 lakh rupees over a period of 10 years. But if you allow that value to grow, the total corpus for you would have become 27.02 lakh rupees. With just 500 dirhams over a 10-year period, you are able to accumulate 27 lakh rupees, 2.7 million rupees. Okay. Then, if you move to the same thing over a 15-year period, your accumulation would have been 18 lakh rupees, whereas your value would have become 60 lakh rupees at the end of 15 years. But if you continue the same thing over a 20-year period, you would be left with 2.23 crore rupees. That is why I say SIP will make you a crorepati. Actually, a double crorepati, not single crorepati, a double crorepati. Yeah. So something as small as this can make you wealthier by 2 crore rupees at the end of 20 years of your working career. So that is what is very important. You can start as small as this. Okay. So when I talk to Asfar, and I mean, this is what I'm seeing in his client base also, we see a lot of his investors have not done SIP. So what surprises me is, can an investor not even save 500 dirhams a month? So I'm leaving you with this very important point to think about. Now the next thing, Asfar,
Yeah.
is I want to understand how many of y'all have your financial goals laid out. What does that mean? Do you know when you want to retire and how much money you need, and are you ready for it? Second, do you know when your kids are going to go for higher education? Are you ready for it? How much money they need? How much money do they need for wedding? Are you ready for that? How much money they need? Have you laid out your financial goals? Do you have it on a piece of paper which tells you, these are my goals? I need 5 crores for my retirement. I need 2 crores each for my children's education. I need 2 crores each for their wedding. And this is where the money is going to come from. This is how I'm planning. Do you have that laid out? Yes or no? Please answer.
So 30 people have.
All right. Do we have all of the answers, Asfar?
Yes. Share results.
Can you present the results? Wow. That is a good response. That is a good response. So 80% of people believe that they've laid out their plans of what their financial goals are. Okay. So I hope all of you all have taken the inflation into consideration. I hope you've been able to map your financial goals and all of that. But I think, Asfar, if 80% of them are saying they've mapped their financial goals, I think your role as an advisor is quite successful. Okay. So I must really congratulate you on that. But what's important is to really put their investment goals on a tracking mechanism, where they have an indicator that this investment is for this goal, this investment is for this goal, so on and so forth. So I think that is something you must do with people. So let's get to a stage where we will bring up those kind of an exercise also, which you can do with your clients. So now going into my presentation again, this is all you need. This much is all you need. Bas itna hi chahiye, not more than this. So ye itna kitna hota hai? Let's try and understand that. If you want to have a comfortable retirement for yourself, you need to do only 10,000 rupees a month, which is again 500 dirhams a month. If you want to have your kids' education properly planned out, that's again 500 dirhams a month. If you want to have your kids' wedding properly done, that's again 500 dirhams a month. So at 1500 dirhams a month, is it big? Asfar, do you think 1500 dirhams is big for a lot of people in UAE today?
It depends on the current situation and things like that. But I think 1,000 dirhams to 1,500 is an easy to save for everybody. Yeah.
Absolutely. And that is very important to remember, that don't worry about the current situation. We will tide over the current situation. All of this are going to be, we are going to be past this. This will also pass. Okay. But what's important to remember is with just about 1500 dirhams, you are able to achieve three big goals of your life. Isn't that so beautiful to think about? Okay. So what is the mantra? The mantra for this is start early, invest in the right asset class, save regularly. That will lead you towards your goal achievement. Please remember this mantra very, very clearly. Start early, invest in the right asset class, save regularly, and that is what will get you towards the goal achievement. This is the right way of doing it. Okay, that is why SIP is very important. Last but not the least, to quickly summarize all that we discussed, equity is a fantastic asset class for wealth creation, no doubt about it. Second, time in the market is more important than timing the market. Third, SIP is the key. Don't forget, I showed you it can make you a crorepati. Fourth, planning your financial goals is very, very important. Fifth, starting early is extremely important. But having said that, if you haven't started yet, it's better late than never. Last point is a gentleman who is presenting along with me on this webinar today. It's Asfar. You need to have the right advisor on your side. I think Asfar, while all of you all know him well, I've personally known him also for the past 3-4 years now. I've seen he's been one of the most methodical advisors that I've seen, very close to his clients, puts investor interest first, and hence you have the right man for the right job on your side. So getting the right advisor is important, but that part of it is done for you. So Asfar, now these are the points that I wanted to share from my side. And if you can quickly run that poll again, Asfar, to let's, I think we need to also quickly assess at the end of the presentation,
Yes.
what do people think about the various questions we asked them? So can we run the end of session poll, please?
Yeah. 1 second. So we will. I will share with you the first thing. So the first one was equity is risky, which was 87% yes, and no was 13%. Then the second one was
I think let's just run the second set of polls, and then probably we'll
yeah.
compare the results later.
Okay.
So the first poll that Asfar will run now is to say that how many of you all still think, okay, we have seen that even during market falls, even during pandemics, even after the market falling by 50-60% also, we have seen that mutual funds have delivered 16-17% return over long term. So how many of you all think that equity even right now you think is risky? How many of you all think so? Have you got the answers, Asfar?
Yeah, I will wait for another almost.
Yeah, let's wait for 10 seconds. After this, we'll run the second poll.
Yes. Okay. Okay. I'll share the.
Let's run the next poll on the SIP thing.
Okay. So I'm just sharing the poll result for this thing. Do you still think equity is risky? So
Okay, people still think equity is risky. So I think over one presentation, it is. I think you need to share this presentation with people, Asfar.
yes.
Okay, and once you share this presentation with people, once they get access to the data, I think the percentage has improved little bit.
Yeah.
But I still think there are a lot of people who still find equity risky. So you should share these data points with them to get them to understand. So second point, we saw that mutual funds are very, very important and quite attractive as an investment asset class. So how many of you all think that you will start investing in mutual funds now? And how many of you all believe that you will start increasing your exposure to equity in the next days to come?
Okay.
Yeah.
Yeah. We have got the results.
Wow. This is a big change. Huh?
Yeah.
This is a very big change. So we're glad that we've been able to influence the minds of people to make sure that about 80% of them already believe that they are going to make significant exposure to equity. I think Asfar also the previous poll result is a bit skewed because I think previously there were only about 14 to 15 attendees. So I
Yeah.
think that also could have got the result skewed in the previous case, but I think here it looks quite attractive.
Exactly.
So let's go to the next poll, Asfar, in terms of the financial goals. So how many of you all think right now that clearly laying out and mapping your investments to financial goals is important? And how many of you all require assistance to do this? Can you say yes or no? How many of you all think you need an assistance? How many of you all think you don't need assistance for this anymore? Yes, Aswar, how does
Yeah.
it look?
It looks like 80% have said to they require it, and
Wow.
19%.
So I think if you look at this is a very interesting observation. Okay, Asfar, to you and also to all the audience, if you see, if I remember the last number, okay, I remember that 60 people said they have already planned 60%. Can
Yes.
you bring up the previous figure, Asfar? The
Uh,
poll number 3. Oh,
Once
sorry, the poll number 4. Results of poll number 4.
for yeah.
So if you look at this versus the result now, in this poll, 80% of the people said that, wow, we have our financial goals laid out. We know how it is. Okay. So we are clear about that. But if you look at the poll number 8, can you go to poll number 8 result now, Aswar?
In this, most of them doesn't have laid out. So 80% is not laid out. Anand.
Oh yeah, sorry, it's the other way around. Sorry,
Yeah.
I read it the other way around. So my bad. So we now see that probably people are further believing that they need an assistance to create a financial goal. Okay, they need support in building the financial goal, and I think that is why to sit down with every investor on this conference call, Asfar, it's
Mm.
important to sit with them and probably decide that how much allocation do they need to start making a monthly allocation, how much do they need for each of their goals. That is something that is very, very important to be laid out. So the next poll that Asfar is coming up with is to say how many of you all think that you are going to increase or start doing your SIP. I think in the last poll we saw that the result was about how many of them were not doing SIPs. As far, maybe you can share a comparison as well.
Yeah. I'll just share with that.
Once this is done, you can share the
Yeah.
comparison. Yeah.
So okay, 25 people have voted. I'll just take that number.
So let's share the previous result before sharing this.
Yeah. Okay. 1 second. I'll just share this. So this is 96% have told.
Wow, that's a fantastic number. But I still see that one person says that he's not going to start an SIP. So that's something which is worth noting. But I am glad that a large portion of the people say that they will start.
This was the
Okay.
results.
So that's already an improvement of about 36% as per.
Yeah.
Yeah. So I think that's fantastic. So it's good to see that people, again, just for the benefit of everyone who's on this webinar today, okay, I'm sure a lot of y'all would be thinking that the various topics that are being discussed here are extremely basic in nature. Okay. In fact, when I and Asfar started talking and when we discussed for the first time in terms of what are the topics we should cover on this webinar, okay, I think one of the things that commonly came as a point to all of us, to the both of us, is that we should not complicate the thought process with very complex or very flashy products. It's important to bring everybody back to basics. So that is why we today spoke about understanding that equity is very important. Second, focus on creating your goals. Third, improve your exposure to mutual funds. Fourth, start an SIP. And fifth, have the right advisor on your side. So that is why we thought we'll focus on this. We'll probably do another session sometime later, because we have various platforms to invest into India. We have a dollar denominated fund. We have a stock based portfolio. We have mutual funds. We have all of that. So we'll do it at a later stage. But I think this is all we had today. So Asfar, probably we can move towards
Yeah,
the Q&A, please.
we can go into the Q&A. Before that, I have got some few questions from a few of the investors already.
Cool.
So, like most of the investors ask, like, what is how to time the market? Is it the right time to invest in? Will the market go further down? Should I get into investment at this point of time? So, what will be your viewpoint on the same?
Okay, so good. So that's a very interesting question, Asfar. That's a question which is on everybody's mind as we speak today. So one of the things which is critical to note is one of the important indicators of the market is something called the market cap to GDP ratio. So if you look at the market cap to GDP ratio for India over the past, let's say 7 to 8 to 9 year period, the market cap to GDP ratio has been in the range of 70 to 75. Whereas today, the market cap to GDP ratio is an average of about 50 to 55. So it clearly means that we are living in a sort of pessimistic environment due to the COVID-19 situation. But yes, the markets are still very, very attractive. That is why the market cap to GDP ratio is just between the 50 to 55 mark. Second, if you look at the price earning multiple of the market valuations are very, very attractive. The earnings estimates are looking very, very attractive. So it's very important that you look at an opportunistic way of investing today. But I won't say that it's important to bring in all your money today. There will not be an opportunity tomorrow. I think you need to stagger your investments over a period of time. So hence, SIP is very important. Second, whatever corpus you have today left with you, that you can leave it for a long-term exposure. That is something that you can go all in with.
Okay, thank you, Anand.
Yeah.
Most frequently asked question, do you think market will correct further from these levels? If so, what sort of correction, under 10%, or how long do you think this volatile period will be there?
I think today, yeah, like you rightly said, it is the frequently asked question. So today, if you look at again the market volatility stage, okay, in our dynamic portfolios today, see what drives the market. That is very important to understand. A, earnings growth rate of India as a conglomerate. Second is interest rate cycles. Third is market valuation. So if you look at these three important factors, today, our model tells us that we are 85% exposed to equity and 15% exposure to debt. So when we are having 85% exposure to equity as per the model, it clearly means that the market has significantly corrected already. But when I'm still sitting on 15% in debt, it means that it has not hit the bottom. Okay, there is still some opportunity where we are going to see a little more correction in the market, but to the tune of about 15%. I'm sitting in cash as at the moment. So I think from that standpoint, we have not hit the bottom yet, but we've more or less reached the bottom almost.
Okay, so because a few of the questions are already coming there, like, how long it will take to market to stabilize,
So I
and things
think
like
if I
that.
have to take that question, I think this is a question from Mr. Suhail.
Yeah.
Okay, so Mr. Suhail, how long it will take for the market to stabilize? Today, the market volatility is largely due to the COVID-19 situation. Okay, so the COVID-19 situation and the stability of the market, hence, will definitely come only when we find the medical solution to this problem. So in this situation, we have two problems. One is a medical problem, and then second is the financial problem. Once we find the medical solution, the financial solution will automatically come. So this to me looks like about a quarter or two for the recovery to start looking up. And I think post that in about a year or so, we should see some stability.
There's a question from Parivesh. Which kind of mutual funds are better, SIP or lump sum considering today's market?
So, Mr. Bora, I think SIP is definitely a good asset class because you are participating across different market levels. So that is something which is very important. Having said that, you should take a lump sum exposure also if you have some capital that you can comfortably allocate for a 5-year, 7-year period. That much amount of lump sum is something that you can definitely do today. So it's not either lump sum or SIP, it's a combination of both.
Yeah. There is one more question. Like, okay, it's more about detail about SIP and equity connected from Suhail. I think
Okay.
we can do maybe a separate session with him. I'll do with him maybe
Sure, sure,
another level.
sure,
Uh,
sure.
Another question which I have in my another thing is that it's a cash liquidity. Now we have recently heard from the government, like there's a 4 to 5% cash liquidity that's going to be injected into the market. Another 5% stimulus community economy from this sort of liquidity coming in. What will be the economic outlook? Seeing the revenue constraint and things like
Okay, so that's an interesting question, Asfar, because today, if you look at India or any of the other markets around the world, also, there are two types of packages that are coming. One is fiscal stimulus, and second one is economical stimulus. So, fiscal stimulus is important to stabilize the market, to stabilize the consumers, to stabilize all the people who are living in the country. Economic stimulus is something which brings a lot of stability in the economy. So I think it is going hand in glove. So today, if you see, stimulus will help, but I think it's more from a long term perspective, and on a short term, the fiscal stimulus is helping people to sort of get a temporary relief in the current economic situation. So today, if you see India also, there's about a 20 lakh crore financial stimulus which is being passed. There are a lot of rebates in terms of taxation, etc., which is being given to corporates and so on and so forth. There is a lot of facilitation which is done in terms of corporates to come and establish business in India. So yes, the financial stability, stimulus and fiscal stimulus is helping out, but we will see results of this panning out only over the next 3 or 4 quarters is when we will start looking at these numbers playing out.
Okay. Now we have one question from Vinod Kumar. Has the market bottomed out or started the revival trend? Isn't it better to invest when we have confidence that the upward trend has started?
So I think Vinod, I'm drawing you back. Your question will draw us back to the dichotomy that I shared. Okay, so today, like I said, if you look at the earnings growth rate, interest rate cycles, market valuations, today the model tells us we should be 85% in equity and 15% in debt. So what it means is that the market has not bottomed out, but we should stay 85% in equity. So equity is attractive today. So if you say that you are going to wait, so you will probably wait for the period when the emotions and sentiments and the news in the market is already positive. So at that stage, people who are investing today and are increasing exposure to equity today, they would be ahead of you in terms of the curve. So what I am suggesting is that you start investing today, keep building your exposure. I'm not saying that you bring all in, you come all in, but you should start increasing your exposure today because we believe that the upward trend will start sometime sooner than later. I think the medical solution to the problem is around the corner. So I think the financial solution also, the stimulus and the various impetus that's being put in will start showing up its signs. So I think you should start today if you've not already.
We have a question from Abraham. Considering today's market situation, investment in large cap, mid cap, small cap advisable, which
So
is
I think, Abraham, that's a very good question. So I would say that, see, in the COVID-19 sort of situation, okay, I wouldn't focus on small cap, micro cap, or those kind of companies. I would focus on largely funds or companies which are large cap or blue chip or multi cap in nature. Okay, I would want to look at companies which are going to remain sustainable, because survival of the fittest is going to become the key. So I think to focus on large cap or multi cap sort of investment strategies, or blue chip sort of investment strategies, are going to be good for the next a year or two to come.
We have a question from Talish. You mentioned market will go up, showing examples of other post-pandemics. But right now, we are advised by the healthcare experts to live with the COVID. Means COVID will remain for lifelong or long term, which means we cannot compare with any other pandemic with COVID. Are you sure these dropped values will improve better, or at least at the level of previous market level?
So Talish, let me share some interesting analysis with you. If you look at the United States, okay, the number of people who have died of COVID-19 is around the 20 to 25,000 mark, if I know it right, Aswar. Am I right?
Yes, yes, yes.
Okay. But a very less known fact, Alish, is that every year, 30,000 people in the US die out of common flu. Were you aware of this? This is something we don't know, but that's the reality. Okay, so that is where I told you, okay, the noise and the effect of WhatsApp university, Facebook university, etc., is creating a lot of panic. COVID-19 will also become a kind of common flu. That is why people of WHO and all the medical experts are saying that we need to learn to live with it. Because if you look at what UK has done, is UK has decided that we are not going to be able to stay indoors forever, and we will have to go out. Probably some of us may get infected, but our body's immunity has to start kicking in. And then over a period of time, we will develop what is called as a herd immunity. So over a period of time, our body immunity and all of such situations will start playing in our favor. If we continue to stay indoors, it's not going to help. Okay, we'll have to go out, start facing the situation, build your immunity. So that is why a lot of medical experts are saying that we'll have to learn to live with it. We're living with 10,000 type of flus. Huh? Let me tell you, 30,000 people are dying of common flu every year in the US. So this is not a big number. I mean, that is something which people are dying. So due to COVID-19, that will probably add another 5% to it. But yes, so we will need to live with it. We need to build immunity, but it's not the end of the world. So let's remember that it's not the end of the world. Second, when you talk about drop values, okay, I think it's very difficult to really predict the exact bottom of the market, but we believe that we are close to the bottom of the market. That is why I'm not saying sell all your assets and bring and put it in equity. That's not what I'm telling you. I'm saying markets are attractive. You need to start allocating. Start allocating every month. If you have some corpus that you can leave for 7 to 10 years, you should put it today. So that's my answer to this question.
Okay.
As
Uh,
per.
I hope Talish, you're okay with what Anand has replied. Okay, now Parivesh has another question coming in. Which sectors will give better returns on market in coming times, or even which can be, which do you think which will have a much bigger impact on the economy?
So Parivesh, before I answer your question, I want to tell you, don't steal us of our jobs. Huh? So so don't try to I would say, don't worry about looking at which sector will do well, which company will do well. That's our job. We will do it for you. We'll take care of that for you. But having said that, I want to answer this question in a very reasonable way. Okay, see, we've been into this session for more than an hour. Okay, I've shown you some data. Okay, and we've seen that when Asfar ran that okay, so Asfar, can you bring up that equity wala poll once again?
Okay, 1 second.
The post session equity poll.
Post session. Okay. Yes.
Okay, so if you look at this, there are still 68% of people who think that equity is still risky.
No,
And
68% are telling no.
68, but we still believe, sorry, okay, it's always I'm looking at the other way, sorry. So 32% people still think that equity is risky, correct? So now let me talk about these 32% of people. And this 32% of people is there within everybody as we speak at different points in time. Okay. So now again, I'm responding to Parivesh, but I'm also responding to everybody else here. Okay. Today, whether I'm able to convince you, whether we during the session are able to convince you about equity or not, tomorrow morning when you wake up, you're going to use a toothpaste to brush. You're going to use a soap to bathe yourself. You're going to use a shampoo to clean your hair. You're going to use a car to drive you to wherever you have to go. Irrespective of what you think the market is going to deliver wealth or not, create wealth for you or not, your consumption is going to drive the market. So you can tell yourself, hey, I believe that the equity is risky. I'm not going to invest money. Okay. But because you're going to buy a paste, you're going to buy a shampoo, you're going to buy a car, you're going to buy pulses, you're going to buy clothes, somebody else who's investing money in the markets is going to get benefit of you consuming. So the bottom line answer to your question, Parivesh, is that consumption oriented sectors are going to do very well. Equity markets will deliver fantastic results, but it will continue to remain choppy over periods of time. So focusing on SIP, focusing on dynamic asset allocation is extremely important.
Okay. We have another question from Anthony and Jocelyn. In which aspect choose mutual fund return versus currency depreciation?
I don't really understand the question well, but I would assume that they are asking me that even with the currency depreciation which is happening, should
Yeah.
you still choose mutual funds? Is that
Mutual
the
fund.
question you think, Asper?
Exactly. Mutual
Okay.
fund return, maybe it's giving 15% over a longer period. But as an investor in, Middle East, or, as an NRE, you will be investing through INR, which will have an currency depreciation. So that's what their question will be.
So I think that's a very interesting question, Anthony and Jocelyn. Okay, so we all are talking about rupee versus dollar depreciation today because in the last year or two, the dollar depreciation has been 7 to 10%. But if I have to talk about the last 15 to 20 years track record, rupee has always devalued vis-a-vis the dollar to the extent of 4.5 to 5%. Okay, so it's not new. It's going to happen. It will continue to happen till the time India becomes like an example of the UAE. So UAE today, the UAE dirham is pegged at 3.65%. 3.65. Am
Yeah.
I right?
Yeah.
Vis-a-vis the dollar.
Yes. Pegged with
But
dollar.
the rupee is still varying significantly vis-a-vis the dollar because India today is a net exporter. Sorry, is a net importer, not a net exporter. So today, if you look at the UAE, okay, UAE today, the government is a net exporter because of the oil and other aspects. So UAE is a net exporter. But India, we are a net importer today as we speak. So that is why India today is focusing on Make in India initiatives, bringing a lot of global companies to India, so on and so forth, where we are going to make sure that our currency becomes stronger. Despite all of this, we see that over the next 5, 7, 10, 15 years period, we will see that the currency will get stabilized vis-a-vis the dollar. But having said that, even if it doesn't, the developed markets have delivered a return of about 6 to 7% in dollar, whereas the Indian mutual funds have delivered 10 to 11% to the dollar. So even despite the rupee devaluation vis-a-vis the dollar, the Indian mutual funds have delivered a 5 to 5.5% outperformance over the global markets. So I think there's always a good enough arbitrage and there is a good enough opportunity.
Okay. We have another question from Fawaz. What should be the portfolio allocation in these times?
So I think for us, I think what's important is it's not a one size fits all approach. Like I told you, the walking stick model. So you need to be able to see where you fit in the walking stick model. So if you're in the age of 22 to 40, you should be overexposed to equity. If you're in the age of 40 to 50, you should be probably 40% equity and 60% debt. 40% equity, 40%, yeah, 40% equity and 60% balanced. And when you're in the age of 50 plus, I think you should move to 100% balanced. So that's what I would say. So Fawaz, I really don't know how old you are. Asfar knows it, so he'll help you out with that.
Okay, I'll add one more question to that. How should an investor diversify in his portfolio of equity and debt in across the age group, or any other assets that forming a part of his portfolio?
So I think first is from an asset class perspective, it's important to focus on three aspects. One is you need to be invested in an SIP. Second is you need to focus on lump sum investments in mutual funds. Third, you need to also build a stock portfolio for yourself, which is qualitative and long term in nature. Okay. Other than that, in terms of if you look at equity and debt, okay, I would say that it is not a fixed asset allocation game. It should be a dynamic asset allocation game. I wouldn't say that if you are, let's say, 22 to 40, I wouldn't say that you should be 100% equity, but you should have more exposure to equity on a dynamic model. You should be aggressive over towards equity in that dynamic model. So I think it's a game of focusing on booking profits in on equity when the markets are rising, and entering the markets at undervaluation when the markets are falling. So the dynamic asset allocation model is what will play out extremely well.
Okay. Now, one question which I have is that now, okay, now one of the main best performing asset has been gold, and we as an Indian, we are always attached to the gold also. So I get questions from all the investors like, what is should we buy gold? What is the best way to? Is a gold a good asset to buy and keep it, or it can be as an ETF or something like that. So, what is your viewpoint on that?
I hope your wife is not listening to me,
No,
Asfar.
no, she's not there.
You know, so the underlying answer to your questions, I can share some analysis where we've seen that if you look at the last 35 years of returns that gold has delivered versus equity markets, okay, gold has significantly underperformed the equity market. So I think if you talk about gold, you should invest in gold to the extent that makes your wife, mother, or daughters happy, not beyond that. Okay, but focus on investing in equity. Gold from a materialistic value or societal value perspective is good to have, but from an investment asset class standpoint, equity rules the roost.
Okay, thank you, Anand. I think we don't have any further questions. I hope everybody, if you have any questions, please type in so that we can get it answered from Anand itself. Uh, so, if we are not having any more questions, we can wind up the thing.
Yep, yep. I think we've spent good 1 hour 20 minutes time, Asfar. So I think I would like to take this opportunity to really thank you, Asfar, for organizing this session, because it's very important. Yeah, okay. So I think it's very important to understand that equity is a fantastic asset class for wealth creation. And let me tell you, if you don't invest in India today, you will curse yourself in generations to come, and your kids will probably curse you in generations to come. So India is at the tip of the iceberg. So it's a fantastic investment opportunity. Second point is to invest in India. You can use my dollar fund route. You can use our Indian mutual fund platforms. You can use various of these investment opportunities that are available to you. Third important aspect is focus on creating goals and starting your SIPs and so on. Fourth, as a parting note, I would like to thank everyone, and let me assure you, all of us are going to live post COVID-19. So there's nothing that is going to stop us from continuing to live. We will emerge stronger. We will emerge much more dynamic in terms of our approach. So your wealth creation needs are not going to take a backseat. It's probably putting you a couple of steps behind, but you need to re-energize and re-channelize your investments to make sure that your financial goals over long term are achieved. All right. So that's the parting note that I had. And I would request all of you all to stay home and stay safe. And Asfar, once again, thank you very much for organizing this.
Thank you, Anand, for your time, valuable time. Thanks once again for joining this webinar. Thanks for everybody who has joined for this webinar. And please stay safe and stay healthy. And if anybody want to be in touch, please leave me a message. Or we would send an email also asking the feedback of the current webinar. Or would you like to add a few more things which we can come up with the next webinar? And we are also going to do some PMS kind of webinar also, because I can see one of the member has asked about on the PMS also. So we will do a separate session for the portfolio management service. uh, thank you everybody once again. Thank you for joining us. We will be sending a recorded version who have missed out on the initial parts also. Thank you.
Thank you very much. Have a great day and enjoy your
Thank you.
weekend. Bye bye.
Thank you. Bye bye.